The holiday shopping season is now in full swing, and it's off to a somewhat bumpy start, with Black Friday sales coming in lower than expected. But one clear winner, buy now, pay later. According to Adobe Analytics, shoppers will fund more than $780 million worth of purchases with BNPL today alone. That's a 19% jump from last year, and total buy now, pay later sales for the month are expected to top $9 billion. Those numbers are giving publicly traded Affirm a boost today. Its shares are up more than 10%. And my next guest knows all about it. His privately held company saw orders soar nearly 30% on Black Friday. Joining me now in an exchange exclusive is Klarna CEO Sebastian Siemiatkowski. Sebastian, welcome back. Good to see you.
Good to have me. Thank you for having me.
What can you tell us about Cyber Monday so far?
Well, just like you mentioned, I mean, we were quite shocked to see the fantastic performance of Buy Now Pay Later. We actually grew 30%. And I think in general, the numbers we found from Adobe was that we saw a 7.5% increase. So it just shows how much market share Buy Now Pay Later and Klarna is gaining in the market. I think it's both share of checkout, it's more merchants offering it, and more consumers choosing it in general. So very positive in general, but it is a more soft performance among merchants in general. And I think to some degree even, the numbers that we saw on Black Friday, I mean, I have seldom seen so good offers and discounts. So that's good for consumers. I'm not entirely sure to what degree that number was an extent of merchants being very, very pushy and trying to get stock out and offering some very aggressive discounting.
Yeah, we have a lot of people have noticed the same thing. We wonder if that's why, in a real term, sales were actually down about 2%. Maybe that's reflective of that deep discounting. Where are the areas where you saw the biggest usage of Buy Now, Pay Later?
Well, I think it's across the field. Like, people have to remember that this is really a growing momentum in the US, because what we have identified is what we call self-aware avoiders. This is 20% of the credit card market in the US that are very tired of the fees, the hidden fees, the revolving accounts, a lot of the bad practices that banks have employed in regards to credit cards. And they're choosing this product as an alternative. It actually reminds me a little bit of, when I was a kid working at Burger King, you could press 1 for debit, press 2 for credit. And that's exactly what we're trying to do here. Give people the option to put on debit and then occasionally put on credit and used in fixed installments, short period of time. You see that everywhere. You see that in clothing and accessories. You see that in video games. You see that in TV and audio. And to give a little bit of sharing with you, PlayStation 5 did fantastic well on that topic.
Interesting. PlayStation 5, there's a good nugget. Okay, PlayStation 5 did very well. So one of the things we're curious about, of course, is just the extent to which people, as they're out there shopping, are using these purchases to kind of reach a little bit versus just because of the convenience of spreading out payments. And it seems like it's displacing those retail credit cards that you mentioned. We've learned recently that some retailers, if my memory serves, Kohl's is one of them, had, upwards of 40% or maybe more of their revenues coming from store-branded credit cards. Do you think you are disrupting that revenue source?
Well, yes and no to some degree, because what we also see, we work with a lot of retailers that have, in parallel with our offering, a co-branded card, right? And it's actually less cannibalization than you would expect, because these are different consumer audience groups that are using these different products. And the self-aware avoiders that we refer to, which is 20% of the credit card market, they would never sign up for those cards as well, because some of these programs, not all of them, but some of them hasn't necessarily been in the best interest of consumers. And they've been maybe slightly too aggressive, some of those programs, when it comes to try to push people to revolve and finally quite costly from a financing perspective. So I think, again, like, my impression of the digitalization that's happened to the world is that it's driving slowly but very safely. It is increasing the kind of perfect markets where it's basically harder in the future to create services that rely on people by mistake falling into late fees or paying high interest rates and so forth. And there needs to be more transparent and open products where consumers take active choices and also understand the consequences of those choices. So I think in general, long term, you will see a trend towards credit products like the one that we offer in the market. But again, I don't think necessarily that it will have that short-term implication that some people may fear.